What's up, everybody? Good morning. All right, time to get started. Welcome to the stream. Oh, we don't have time for the intro. All right, yesterday we covered dynamics. So today we'll have a look at those 55, 52, 55, 87. We out of balance here, 55, 62. So somewhat inconclusive, but likely a long up today for the setup. Nasdaq really quick, right out the door. What's up, YouTube? What's up, friends? These are from our bot in Discord. 19. Wait, is that 19009? Oh wow, that's way down here. Okay. 18927. No way. Very low. $19,318. Oh, so Nasdaq's coming in as a down. Oh, really? What's happening in 1 minute? 318. Nasdaq has a down set of MHP down here lower at the close to lower DD band. What's up, friends? Good morning, good morning, good morning, good morning, warriors. What's up, friends in Zoom? What's up, friends on YouTube? How y'all doing? All right, market's about to open. Looks like we've done a little bit of. This is. I swear, every single day I turn that off. I hate listening to the Thinkorswim ding 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 ding. Thinkorswim. There we go. All right. What's up? Good morning. Let's go to liquidity maps. All right, so Nasdaq has a MHP down closer to D, so 318. So it's a D setup, right? The MHP is above HP, so we'll see what we get for liquidity map. Get ready for SPY to come through. Already today, bull long up. No, that's not today. All right, SPY, looks like we have... Okay, so bull long up on SPY. So this is good, good. So the way that it's set up here, this might be the retracement day then, depending on how resilience comes out. So we know how bull long up typically is. This is a wow, 7 points away. That's for sure. Okay. So this is one of those days that could possibly sell off a little bit. There's that, but then there's also a long trade from here to DD band with threats greater than 0. That to whatever level. So this is a long entry point from here. I don't like to take this though, unless I get a really strong resilience, and it's strong enough to take a little long. Open, gap open. Village shirt is back out. It's gonna be a great day. right, take a look at Qs really quick. So there's a long entry point from here. That's not too terribly bad. QQQ, and it's a very strong mean reversion as well. So QQQ is kind of a same boat here. Break point out. I'm just going to use the same lines I just drew. QQQ has break point if we do break into bull zone and keep going. I don't like to normally... Actually, I don't normally bet that we break into bull zone. I definitely don't short off a bull zone in this environment with DD so close to 1. Nice and bullish. So again, there are dips to buy. So if this market just decides to like sell off today, this area are dips to get in on. Remember, I always bet on MHP reversals. So today, just like yesterday, dips to buy if I can get it. Small chase trade here to DD band if you can find it. That's it. Okay, so let's double check VIX. It's a bull setup today. All three of the things that I'm looking at are bull setups. Let me double check SPY again. Okay, oh that's weird. Maybe I was just getting yesterday's. Okay, forget I said anything. It's still the bull setup, but this is not what I was drawing earlier. This is yesterday's setup. That it was earlier. This is today's. Maybe we hadn't updated yet. Okay, so there's the play here, and then break right here. DD band. That's the play. It's 1A and 1B trade. Okay. Yeah, mine was I was still looking at yesterday's trade, but it's still BLU, same setup. Okay, so no sell off today. Hedge pressure long, small setup if I have it. Any break right here, we know there's Matt's favorite trade is always that hook right there. So open support is a long from here up to DD band if we can find it. See how far away that is. Yeah, so not terribly bad. So this is pretty much the play. And then relatively speaking, bull zone support. Okay, so hedge pressure long I'll probably take. Bull zone support I'll definitely take. Okay. All right. Any support on bull zone, I'll usually take with a small long on Qs if we do come back and pull back there. We're still in the digestion mode from the move up on CPI, so I'm going to be very in and out with some of my trades. VIX is a mean reverting setup. Friends on YouTube, don't forget to hit that like button. We love you. Thumbs up. Yeah, I was yeah, thanks for letting me know. My thing had not connected. Let me see. Forget that right now. VIX is sort of kind of like in this mean reverting state. If VIX breaks through MHP 25. There's an illiquidity pocket on VIX. This is pretty bad. So just keep an eye out today. This is your bad news setup, right? VIX can go crazy on MHP break. So VIX is okay here. So if we start to get any kind of selling, the market's extremely fragile. So be careful. And VIX hedge breaks into illiquidity pockets, bear zone above bull. VIX can go quick. So this is why hedge pressure a lot of times we do trade with small setups on today's move. Any support here is a small setup trade. Any selling that really quickly happens inside of here, VIX can go a little crazy. So with VIX being crazy, it would be like in and out if I get that move. This is a leg. That's what I'm looking for today. Future options ain't no options today. Digestion days after big moves like this, don't even touch options. You're just going to burn up theta. Usually it takes about 3 days after a big digestion move on average to see any kind of big continuation or reversal. Like I'm talking about big. Because usually what happens is, you know, the market moves very rapidly on an event and then sits still. And then people are in margin calls after, you know, 3 days or whatever. And then typically everybody exhausts that loss that they have. They finally realize that loss, and the market is able to like freely move. So imagine you try to short before CPI, market blew up, way up where it did, and then you haven't acted. Yeah, you're still holding onto that loss with your fingers crossed. You got your margin call. And then finally today, or whenever you closed out, it's the third day. Everybody closed out, and then Monday it sold off, you know. And everybody's like, oh, man, if I just hold on for one more day, right? So no options today. The market's kind of structuring itself to be very bullish. Just a hide. Zoom, like I can hide this so I can have to redraw it. I'll do monthly maps super quickly. Remember, it's starting to structure itself pretty interesting. Leading up in October, huge inflection point, right? Bearish, bearish. It's like night and day difference. Now the bull zones, the bear zones have started to disappear now, right? The market has figured out its way to survive. It's like 1 week bull. We said this earlier in the week, right? Leading up into, yeah, 1 week of bullishness. And then bear wave, bear wave. It's like a complete inflection point. After expiration. So it's interesting to see the market still structured this way. There's still very little confidence in this market right here. Even with the CPI moving like this, this is structuring itself even more rigidly to the bear side. When you see monthlies, you see it like these weeklies move up like this, it's very bearish around this time frame. So while September is kind of like going to do its thing, I'm still in the mode of we have 2 waves down, and we're going to try to find this. Remember, markets don't forget flash crashes. They attempt to try to move their way down. We could have something like this. So I don't think we're in the bull clear yet. It looks good for now, but we'll see, right? The market, we're going to wake up market structure. It's going to be market structure. There's still people that have doubts on the index, though. You can see the way that it is. From these levels, though, it's starting to get slightly better. There's all this volatility, right? This is not normal for a bull market. Let's see what QQQ said I'm doing. So QQQ is starting to lose a lot of that bear zone resistance that we saw up in here. Still a little bit. Those liquidity pockets with those like dangerous volatility is gone, which is good. QQQ somewhat choppy. Bulls liquidating, bears liquidating. QQQ has a lot of volatility coming up, leading into Fed. So other than that, a little inconclusive, but QQQ's strength is revealing itself today, so I'm not afraid of this market at all anymore, at least on Q side. But S&P still shows a little bit of weirdness. All right, so again, I probably missed an entry on this one, but it's moving up a little higher. I don't really have an entry point from here other than hedge pressure, bull zone. So if I get those taps, I'll take those trades. Here to here's a scalp, like we said. Here to the middle is a scalp. You're gonna sell options today. You get daily or monthly maps on sell. Oh, CELH, Sherry. A lot of times there's just no data, so it might likely be there tomorrow. So sometimes if somebody hasn't ever looked for it, which happens, it's not on our list. We don't pull it. So if it's been looked for, then it'll be on the list for tomorrow. USO and GLE take about 5-6 minutes to show up. I think it just has to do with how quickly we get the data calculated. We have a priority on the index at the top, but basically the priority is based on the requests at which people search and look for something. So usually ETFs are at the top part of the list There's a separate part for ETF. I don't. If it just takes that long to calculate, it's just how long it takes for the algorithm to do that. Calculating so much information. So as long as it comes in less than 10 minutes, it's good. We have to crunch a lot of data, so there's just an order at which it's done. With the infinite number of stocks you can do and options that come with it. YG's gonna sell options today. Yeah. I'll be right back. All right, you guys, I am back. Zoom has higher quality audio. Yeah, it definitely does. All right, guys. Still digestion day off of the last couple moves that we've had. Big ups on CPI. No real bearish signs anywhere anymore, other than the S&P kind of has that bearish look after Fed and that volatility that's kind of sitting there. But the bearish part on monthly maps you see is like the streams have gone by every week has been like disintegrating little by little by little. I think that lower number on CPI, 2.5 is what it was, right, on the year over year, and I think that's really put some confidence in Wall Street that the Fed meeting is going to likely call for rate cuts. Right. Obviously, that's a very big drop, and Powell reluctant to cut rates until inflation comes down has been kind of his MO. And the jobs data is showing jolts are coming down. There's no new unemployment. There's no new people getting fired, laid off outside of the norm. All the data looks the same on the job side, and numbers are coming down, which just means basically inflation is kind of curbing itself. Cost of labor is coming down. Cost of raw materials, goods, all that stuff, all the delays built into pricing due to COVID, all that stuff has worked its way out. And inflation is coming down, which is good. The housing market, since we're looking for houses right now, you can tell interest rates are starting to come down a little bit out there on mortgage loans. It's becoming easier to buy a house. So, the market's looking pretty darn good. Where's the doc sleeping in? Yeah, probably. No setup today, I guess. So apparently, Elite Trader Funding is having a big discount. They're doing a 70% off non-fast track evals. So very, very rarely do I see them there have their prices this lower. We're a big fan of the Elite Trader Funding group here. So if you guys go to their website, they have a deal that's going on right now. We don't get any incentive by saying this, so there's no payment I get. But they're a good team. You're not using what I mean is you're not using like an endorsement link that I have or something. They just have a sale. I just was reading the email. 70% off evals, which is it's making them like Apex level competitive evals, which is like go scoop a bunch of them up if you guys are doing those eval accounts. Thoughts on Meta? Yeah, take a look really quick. So anytime that you get hedge breaks, it's pretty interesting right here. You get a hedge break and it supports this way, then very often the market creates a big squeeze off of that. So as long as Meta is above here, you're going to start to see some momentum picking up. As long as it stays there, what I normally do is I try to find some upper targets. If you have any gap fills or anything, and Meta doesn't really have anything other than internal trades inside of these couple of days here. I'm going to kind of estimate this one. So like upper targets, like Meta is looking really solid for a breakout. That's a bull zone, bear zone flip typically. Trying to see if there's like any retracement levels inside of here. Don't really see anything. This looks like it kind of. So internally retracing some kind of target inside of here, maybe even double tapping the highs. Looks solid. Everything looks solid today, actually. We got the data provider to fix the Meta thing back in the day. Yeah, we did. I literally had to give them a presentation. It's like I told them, I was like, Meta, your data on Meta is incorrect. And they're like, okay, we'll look into it. Nothing happened. I said it again for like almost a year. I was like, your data for Meta is incorrect. Your model for Meta's Greeks are incorrect. And then they go, okay, whatever. I don't, it's not like I was like I knew that they were incorrect. I could see and I knew exactly what was wrong. And so then they didn't do anything. Then finally I made a presentation. I said, look, you guys have breached your contract by providing incorrect data for one ticker. This is not Meta's data you're giving. So what they had done was indexed the old stock ticker that was with Meta and all the information in that. And the Greeks require, or for Black-Scholes require like some extracurricular data. Is that as Greeks are balanced around the risk-free rate. And so it's like dynamically that portion wasn't updating because it was still hard-coded to the old Meta ticker. So I was like, you know, you guys, your model's incorrect for Meta. And I wrote them like a little write-up to tell them exactly where their calculation was wrong, just by looking at the numbers. I'm like, I figured out where your calculation's wrong, and this is it. And then they looked at it and go, oh. And then, you know, within a week, it was fixed. So the funny thing was when I was reporting that Meta was wrong, I was like, Meta's information is wrong. Your data, so this is a data provider that provides to institutional Wall Street, by the way, has been giving wrong data to Meta for a very long time. So, you know, just letting you know, since Meta became Meta instead of Facebook, they've been providing the wrong options data to basically every major tech provider in the financial space and major educational space. These guys supply option data to just about everybody that's big. And it's like when I told them it was wrong, maybe they couldn't figure it out. Or maybe they just didn't believe me. But when I sent them the answer, then they were like, oh, okay. So maybe they didn't know they didn't know what was wrong. Maybe they couldn't figure it out, and I figured it out for them. And when I did, they fixed it. So yeah, answer your question, Ben. You know me, I solved the math, and that's how I did it. Got to see that hedge pressure tap on S&P. This is too rich for my blood to buy right here as the market's just pushing higher. Trickle days like this are usually long at the open. That just happened too quick. I didn't grab it. My platform wasn't logged in because I had logged out earlier. And so it was loading yesterday's liquidity map. By the time I loaded it up, we'd already kind of moved to here. So this just trickles up until we hit those DD bands on the upper side. Not really. This is the target. Hedge pressure is about right here. And right about 55.90, give or take. Oops. Right about here is bull zone. My trades are here to here if we get it. Right here if we get it. Is there a spike conversion for DD bands? You can convert, yeah, you can convert one to the other just by using a simple cross multiplication. So if you have like, I don't know, SPY hedge pressure 559, and you want to convert it to X, right, which is going to be ES. And what you just basically do is you just do a cross multiplication of price. Like current price right now is 561.03 divided by what it is right now, 56.21. And then solve for X. And then basically you get a level for converting one to the other. The problem is that what we call the conversion ratio. The conversion ratio is never the same. So they trade like this, right? So that ratio like dances around. Because SPY and S&P futures never really trade exactly together. Sometimes they do this. Because that happens tick for tick is random, the noise of the market is very random. The level you convert to is always going to like dance around. So at any given time you calculate it, Joe. You understand it's not going to ever be static. Which is why it's good to look at S&P futures here and SPY here side by side. The futures calculations be futures, the SPY calculations be SPY, and look at them together where they're static. If you try to cram them all into one chart, the converted ones will do what we call the dance. See that? So if you don't have futures data feed, there's a channel in our chat called Futures Conversions. What they do is they convert the data at 9:30. So the reference point, the common reference point that people do is they convert it at 9:30. Now again, that's not as accurate as it should be. What you do is you make a spreadsheet and you open up Thinkorswim and you can import the data from Thinkorswim in real time. Definitely open. Oh, mine isn't open. So basically, like, you create this equation you see on my screen in Thinkorswim, and you can actually import the live data. I have a video on YouTube. If you go to my YouTube video, it actually talks about a video on YouTube. Actually, so I have this today. Oh, PPI is today. Today's PPI, isn't it? I totally wasn't paying attention. PPI. Where's the Michigan numbers? For consumer sentiment. Oh, this is the Michigan numbers, right? PPI was pre-market, I think. Or was that yesterday? I was gone. That was, sorry, PPI was yesterday. I'm an idiot. Today is Michigan numbers. Inflation expectations for September. For 1 year at par. 5 year kind of at par. Consumer expectations in general. 73 on a 71. Slightly better. Consumer sentiment slightly better. Everything's pretty decent. The inflation came down for the most part on the short term. Long term's a wash. So I'd say there's no effect on it. Looks like there is no effect. We return to where we started. Let's look at the... yeah, so that is the catalyst in there. Anyways, I have a video on how to do this on Thinkorswim. It's literally called Thinkorswim something or other. Go to my static videos. There's not that many of them. And I talk about how to do this. So if you want the real-time version, what you do is you create a little ratio for yourself. And then you solve for X in real time. So X moves around. So what you'll basically do, as an example, is I wanted to create a futures target to an equities target. I don't really, the farther away it is, you know, it's going to be dancing around. I don't care to watch these like numbers move around. But if we get close to it, then I'll run that conversion really quick and see about where it is, right? And kind of eyeball it. That way I'm not always trying to like, okay, where's these moving targets moving around to? Yeah. The bigger takeaway is that on both short term, which is the 1 year, and the 5 year, the 1 year is down. 5 years up, but up a little bit. 3.1 over 3. Actually, the 5 year has been going up since last year. But I mean, it's like 2.9 up to 3.1. That's not a big... the trend is higher, as since 2020, people are expecting the 5 year has kind of aimed at the 3% average. Still relatively high, which means, you know, it's still a slower, soft landing. At least in the 1 year, that's quick. The 1 year has been in decline since the recession ended in October of 2022. So from here, decently enough, all data is looking pretty solid. Consumer expectations, 73 on a 71. So the 5 year is slightly higher, but in general, the consumer expectations being high is good. So market just spanned 28 to 10. When you move on an event and return back to where you started, the event's numbers were priced in. So we're already pricing in inflation coming down already. So I'm looking for hedge pressure and bull zone to trade from. Just waiting for those pivots to come out. I'm going to chase into a long right here. Beta still looks decent. Yeah, so it seems like we're going to finish out this trading month similarly strong. We got expiration a week from now on the monthly side. I'm not chasing along from here. I'm going to wait for my targets to get in. The thing with Financial Juice, Justin, you're asking, Financial Juice isn't a news source. It's a news aggregator for the most part. They basically take all the real-time news feeds that are out there and just aggregate them into one feed. So you're not really getting like exclusive news the moment it comes out from them. There's always like a little bit of delay because when other people release the news, they capture it and then they display it, right? So something like, I would say that what Joe... Adam Ross, your question, only I could see that. By the way, you sent your question to host and panelists, so ask your question to the group if you care. Somebody asked who's been profitable this month. Everybody in Zoom call, somebody was asking who's been profitable this month. Me. See my trades, my video from last week. All right, so here, let me share with you guys. Here's a little bit from the Zoom chat. Somebody asked who's been profitable this month. So here's some answers. This is just from the community. Yes. Somebody says, yeah. People are so honest here. I love it. Yes, no, yes, no, yes. Somebody made 10K. Yes, yes, yes with Rocket Scooter. Slightly, we haven't traded much. No, thanks. I don't need this big numbers on my face. Yada, yada. Okay, cool. Somebody says, without Rocket Scooter, likely not. You guys are... So I just need to share that with the group. That's our Zoom chat we have. Our private Zoom chat is real time. YouTube is delayed by 30 seconds. If you guys love to sign up. Am I in trades now? No. No trades now. I'm actually planning for waiting until next week to see what I want to do. My trades are drawn on the screen that I want to take. So, Jonathan, what I normally do is I draw my screen where my levels are and I want to take what I only want to take. You'll see that I'm like the most calculated and patient trader you'll ever see. I already know what I want. So I'm going to wait for it. So these are two of my favorite trade setups. The blue bounce off to the right. You see right here? This little V-shaped move is always a good hook. 59, that's about a 7 or 8 point run. Bulls on bottom is always a good hook too. So here and here as supports today. Both of these are good plays. Now the question is, if we do fall to here, VIX might be in the scary part of the market. So this is definitely a good support with this ratio. It's good. This is the bull bear ratio of the entire stock market. When the market's good, then I bet on the bull zone holding. So here's my, you guys want to check this out. We have a huge, our Zoom call group is massive. Like that's why everybody does here. Everyone in YouTube, check it out. We have like 6,000 members. We're like one of the largest paid futures trading communities on the planet, or bigger than pretty much everybody. Our Zoom call is like the new thing. Everyone loves Zoom a little bit better. It's real time, quality's better. We have 2 Zoom calls a day. We're doing something called 20 Days Profitability Mindset webinar. It's the statistics of why 20 days of trading is the most important thing that you need to understand. There's so many magical things that happen on 20 trading days, which is a month. Markets have statistics that happen on a monthly basis. We talk about all of this stuff in this boot camp. This will by far be the best trading education you've ever had. And it's not even our techniques that make it great. It's the statistics you didn't know. I actually prove that, and I prove this with data, and this is part of what the boot camp covers. The cool thing is that it's all statistics. We proved a case that if a monkey, the blindfold, were to close his eyes and throw a dart at a dartboard to long the market randomly every single day, controlling profit to only lose no more than half of your account over a 20-day period, that the monkey would make money over time. Imagine all the effort that you're putting into. And I proved that over any span of time, recessions, even market crashes, even it doesn't matter. In 2008, it still worked. In 2020, it still worked. We proved it in the webinar. It's such a great expose on what the stock market does. All this effort and work you guys put into the stock market, and you realize a blindfolded monkey could long randomly at random points in the day trading once a day, and all they have to do is throttle their position size to not lose half of their account in a 20-day period. And over time, if you can survive 20 days, you will make money over time. And none of you do it. And we picked scenarios and we showed this. Here's bear setups, here's bull setups. And it worked no matter what statistically. We build all of these frameworks to show you statistically what's the most important part of the market, how to control your position sizing and your risk management. And so it starts off with that basis that all you need to do is blindly long the market with the goal of not losing half your account over a month. And then 12 months later, you will have made money. Randomly longing in the daytime. Literally just randomly longing. At the high, at the dip, at the whatever. You hit your level that you think is resistance, long at it. Hit your level you think it's support, long at it. Long, 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 long. Statistics, and there's no magic here. We literally counted all the days that you can do this. and it came out right. So the 20 days profitability mindset just basically is a proof that you're just managing your positions incorrectly. You're managing your size and your risk incorrectly. So the idea is we built a framework on the Rocksuiter platform, like my tools I built are built on a framework of there's high probability setups that are great, and I wait for them. They're drawn on my screen. So I'm just waiting for them. Sure, I can chase along right now and make a couple bucks, but I'm waiting for the higher probability setup. I try to maintain like a 70 or 80% win rate, so I don't see me trade a lot. Futures wise, right? When I hit that hedge pressure, when I hit that bull zone, I'm gonna hit it hard. So and what's cool is that we start wide with the blindfolded monkey, and then we narrow down to what's actually the highest probable strategy. And we actually kind of cutely made it 20 different sessions. So we're having these live Zoom calls once a day to go over 20 sessions. We cover all the techniques that we do and the way that I trade them. For instance, over here to the right, you may not know this, but there's certain trades I don't take. This shows the actual flow pressures in the market. This is showing me that this blue line is likely to bounce. This is actually a guide for today. It's showing me that the flow path from the open, this black dot is the open, that the flow path is up. That is literally what this is showing me. The algorithm identified this. It shows this. The flow path is up from the open if the open support. The open is support. The flow path is up. No shorting today. If we dip to blue and trade back up, dip to blue, trade back up, this is a good trade. I usually will take these opens out the door, but I missed this one because I was not logged in. And so my thing didn't update until it's here and I decided to sit out. This trade, while there is a flow path, I usually sit out on this one. I don't normally take the breaks to the short side. And then there's a size of position I usually take on each one of these as well. I don't just trade them all the same. In the courses we teach, Jonathan and everybody else, we actually teach you how much I trade on here. So I have a method in futures. I trade either small, medium, or normal. Normal is something that you decide. Normal is your best trade, your highest position you take. We don't say max because we don't want you to think you're maximizing your trade, but normal. Normal is the maximum position you do take based on what you define normal is for you. And what I define as a rule of thumb for normal is how much you're willing to lose in a day, and then lose 5 days in a row with that same exact amount. Then on the 5th day, you don't feel like you got kicked in the stomach or you're going to throw up. You haven't lost so much that you feel nervous or sick. So that maximum 5 days in a row, losing 1, 2, 3, 4, 5, that's your normal. If it's 1,000 a day, 10,000 a day, if your normal is like, you know what, I can lose 20,000 this week and it doesn't matter. If your normal is like, money's tight, I can only lose $100 this week, then your normal is $20 a day. So normal, medium is half of your normal, and small is 10 to 20% of your normal. So you decide what you're willing to lose at the top, and then we give you the rules going forward. From there, small, medium, or normal, each one of these legs I trade differently. We give you an extended guide sheet that shows you how big each of these trades are. Hedge pressure, both of these on the screen. This right here is a small position. I always take small on this one. This one is a normal position. This is Matt's favorite trade. I hit this one really hard if we get it. So somebody said, so many trades now, no trades now, I'm just waiting for my setup. But I do this every single day, and in this and in Zoom call, I'm definitely live there as well, twice a day. Yeah, so to answer your question, with the blindfolded monkey, should just long the market. Yeah, you should never short the market unless everything lines up to be short. You should wake up most day. Now, again, we tell you the criteria for confluence on the long side. We have 3 indicators that are major. Resilience is a gap fill predictor. Resilience is positive, so we are supporting the box. We give you little flashcards to tell you each one of these. This number is greater than half, so this is the low of the day. We're not breaking this, so people selling puts can sell puts down here. Bet that we don't break, etc., etc., etc. And this is all, you know, not investment advice, of course, but just this is statistically what we teach. In the cheat sheets, we have all kind of different rules that we use. Here's today's setup. Top of the box is support. Here's this box. The top of the box is support. And this number is greater than 0, this white one, and it's been greater than 0 all day. So we give you these flashcards just to kind of help remind you what's going on. This is the other one I'm talking about. There's 3 major indicators. Number 1 is the flow path with the liquidity map, the arrows. So that one, we put the flashcard actually on the platform for you. We also, if you click it, it gives you all of them. So every day the algorithm is going to give you some letters, and that is the natural flow path of the market without a catalyst. It's pretty freaking accurate. This is hedging. This is all based on gamma and delta exposure of market makers. Here you got today. If bull zone support is this guy right here, that's if this ratio is greater than half. That's this flashcard. If that number is greater than half, it's bull zone support day. So this is that support there. No shorting today. I've done nothing. No trades. Nothing today. If you guys just want to attend the Zoom calls, I'll give you guys a link for that too. So the Zoom call is practically just, we made it $1 a day to celebrate the 20 days thing. That ended a couple days ago, but since I see some new faces that are asking about it, that's a Zoom call. Come to the webinar series, man. You guys will love it. I promise. For futures, I normally just trade S&P and Nasdaq. So that's basically what I normally trade. So, like being an engineer, like it's all about the numbers here. So my background is in engineering. I've been trading for a decade though. And so this expose is all about statistics and math. It's like accounting cards for blackjack. Expose, it's like this is how you statistically can enhance your edge. So we give you countless number of techniques that are like this is slightly more probable than that, and etc. And our platform is about to get some overhauls to finish out the year. Like our new projects on the platform are to put like the statistics and probabilities of each one of these legs, you know, to draw more lines on the chart as far as flow path goes, all these things I'm drawing manually to actually have them drawn on the chart with the probability under certain conditions that they've worked. So example, we have all these risk management conditions in the platform. So it's like under these conditions, what's the probability that the open supported here? And then on here it would draw like, you know, oh, 80% of the time this held and 20% of the time it fell. And so they have probabilistic back tests on the chart. That's our next step. So that's it. What are the risk interval numbers and how often they change? Somebody had asked. So risk interval number is the average expected range of a sudden move in the market on an event. So they utilize this kind of loss scenario in SPAN, CME Group does, to create what the margin requirements are. And we reverse engineer what that expected move is. Create the risk interval. How often do they change? They will change every single time the margin requirements change. So this table at the bottom has them. So anytime the CME sets what they call the performance bond minimum requirement for clearing firms, fancy word for saying the minimum margin requirement you're supposed to pay to get in that trade. So that margin requirement is where you calculate, or we calculate these risk intervals from it. So an example today, the S&P. So every time that they update that, it will update on our end. So we update ours once a day with these numbers. And something like the S&P risk interval might change once or twice a year. It's pretty solid most of the time. In bear markets, it might change once a month. Something like oil changes every week. So S&P 3775 means that on an event, that's the expected move. Let's look at Nasdaq futures real quick. We had an event today. It's our first exploit that we ever did. So it looks like Nasdaq had some move. in Nasdaq. So we give you this number. It's always saying 144 points. All right. Let's draw a box of 144 points. I'll show you. This is, again, we're the group that reverse engineers stuff in the market. Let's make this a box of 144. So my first thing I ever did was reverse engineer CME span program. Let's make that 144. 19,244. This is a box of 144 and a quarter. So, like, you know, are you guys going to subscribe to the service or what? It's like I'm telling you. Ooh. I mean, that's what the risk. We need to talk about the risk intervals, I guess, today. There's your wick. I mean, you guys can't. There's the expected range on a sudden event in the market. So all of our indicators are like this, right? So how would I know that that the catalyst was a big deal? Is if it would have opened and would have dropped more than that range on the downside. So the expected like the testing range is always that distance. He's not. I think he's looking at his Zoom messages. I do trades in the afternoon session. Sometimes I do. All right. You guys see that, Jonathan? All you guys. So Nasdaq moved up and down on Michigan numbers today, and the exact distance where those wicks are is exactly the number that this is printed in the chart. This is printed, updated every night, and this hasn't changed in a while. So this kind of distance that is spanned on an event is called the risk interval. It's something that's not public information, something we calculate based on CME Group's own methodology. Your margin requirements for futures are calculated based on a risk analysis method they created. And they've detailed what that risk analysis method is, but not all the pieces of it. Well, we figured out how it all works. And so we reverse engineer the expected range of a move, and we call it the risk interval. And so as you see, it's so accurate, it's to the penny. We had an event, market dropped, market raised, market came back. It spanned exactly 144.25, which is this number right here. That's the distance of this box. So there's things that, so all of our methods in the market are like reverse engineering or figuring something out like that, something mechanical. Upper DD band rejection. Oh yeah, so S&P hit DD band, which is another one of our tools here. These numbers are printed once a day. And there's that high target we talked about. DD band is a risk interval up and a risk interval down. So the same number in this table from yesterday's close, there's that distance up and that distance down, the same number. We call it the doomsday band. The guaranteed high volume pivot when you touch it. And it's usually a rejection target. So the long trade ends at DD band. If y'all remember from like my drawings from today, the target was that. That was the target. Right, so today's just a day I was waiting to see it sell a little bit so I can get in on a better dip, but on the S&P, DD ratios here. So this going to that white line, the white line is that DD ratio. So that was the trade setup today. That was kind of an easy one. I wish I would have taken it. I don't trade. No action from me above that green line. To buy the dips today? No, after the big up we had 2 days ago, I'm willing to, I just really kind of want to let the market digest what's going on. I was waiting for like an intraday DD tap to see what happens. I don't know. This can be where the market sells off if it wants to. I'm not really sure, but there are scalps from here, even if it does fall off today. This is a big resistance today, by the way. DD is strong enough to get a bounce from there. I think on a DD rejection, I'm not going to take the hedge pressure long from here to here. Now I'm going to wait for the DD band tap. All the position for days. Yeah, I bet it with options, right? So my multi-day trades are always with options. My video from last week showed I made a $44,000 whatever profit on shorting the Nasdaq before we started selling off. I really literally shorted the market. Let me show you what I did. So you can go back in my streams from like a week ago. You can see that trade. It was, I think, this day or this day. One of these. I think it was this day. No, maybe no. It was. I mean, it was this one. I think. Yeah, it was this day. Somewhere in here. I bought Nasdaq puts and then real trade on that one. So that my swing trades like that right now. I believe that this is going to be down here by Monday to test the market. So today I've been debating on buying puts to fade out this market to retrace. I still haven't pulled the trigger yet though. By the end of the day, I might. If the market rallies, by the end of the day, I'll buy puts. But as far as futures trading, never should hold a futures position overnight through multiple days. Not really worth. You're not going to gain much by holding it through the night. Futures, I usually are only all day trades in and out. Longer term trades, I'll take a slower moving bet. DD bands holding, usually is there a specific reason not to take a small short? You need reinforcement. Why not to short? There's not. We don't have enough statistics to talk about that. We haven't seen enough days, or we haven't actually tallied it up. Let's start over. There's been enough days like this, but what are the statistics to short off a DD band? When it works great. The probability is what I don't know, and maybe that's something we can do. The problem is we need to know what conditions. Like, what were the conditions at the time? Was there a hedge break? Was there not a hedge break? Was the market rational, irrational? And just a general bulk stat, like short from where to where. It's not just short to reverse the day, but like short to some kind of target, right? And so normally I don't short a bull market. I would tell you, we usually tell you that there's called the float rule. And the float rule states that if the market's trading towards lower DD band and the ratio is greater than half, it's better to bet that we bounce off of it. And same thing here. If you're trading to the upper band and the ratio is less than half, then you short off of it. Those are rules we do teach. As far as when it disagrees, like this is bullish and you connect with it, do you short off of it? The answer is I just on the surface wouldn't. Even though it can work, if you do, trade it small. Like that's basically the rule. But we need it. We should calculate the stats. That's actually something we should do. Actually, somebody's asking Zoom call. A lot of times, market sell-offs start from that level, right? But what's the probability that a bull market reverses, a really strong bull market? The point is that, you know, the blind monkey wouldn't short a bull market. Even if today's this big sell-off day, if the probability is really low, then you just trade small. If say like 7 out of 10 times it doesn't reverse, you still want to trade it and trade small, because the 3 times or 2 times or even 1 time it does reverse would be a massive reversal. So imagine you hit DD band and market crashes for the day, and the S&P falls 100 and something points. Well, the idea is the statistics will say this, right? You want your probability to be greater than 50-50. So the way that it works is you take the average, you count all the times you hit that band and when it sells off. You find the average sell-off in a bull market. What's the distance? Let's pretend that it's 100 points in the S&P. Let's pretend it only happens 1 out of 10 times. So to make the math easy, if 1 out of 10 times it falls 100%, then for every 10-point stop loss you put, you lose 10, 10, 10, 10, 10. You'll lose 90 points. For the 1 time it works, you'll make 100. So that you know that, like, you can set your stop loss on the probability so that you break even over time. Any trade setup you do, it all has to do, remember, it's the blind monkey rule. You have to set your position size. So the probability at which it falls, what's the average amount of fall? Then use that probability and set your stop loss to that exact amount, such that you break even over time. The reversal can be massively violent when it happens. The bull side is stronger rather than it is weaker. And also another trick is that if the bull side breaks and you stop out and it hits it again, you take a second trade. You hit it every time it tries to break. Because again, the reversals are big. These are irrational markets and they can fly quick. But they don't often always do. And it's better to long it than it is to short it. This is a higher probability, clearly, because the market's mostly bullish. This is less probability, but that's how you do it. Does that make sense, Yogurt? For the float roll? Yeah, so if you're betting on like a big market sell-off, here to here is always a span range. Just 2 risk interval moves, yeah. So in reality, you can kind of set your own trade plan. It comes with the frequency at which the move works, and then you got to set a rule, right? So you wouldn't necessarily bet like rule from here to here, but you would say that, like, let me go over the last 200 days, and you can set this up in Thinkorswim and just go through and count them. Maybe we'll do that in today's Zoom call. What's the probability to short off a DD band? Even if it works 2 out of 10 times, all that does is change your stop loss. This is what we call like the penny stock method, right? The penny stock will, you will only, if the penny stock rallies 1 out of 20 times and goes up 500%, right? Then 19 of the stocks that you buy, you'll lose everything. The 1 stock that you buy, you'll make 500%. Do the math. You can set the minimum amount that you buy such that losing 19 and winning on 1 still makes you a profit. You have to look at the size of the position and the diversity in which you do. How much you diversify your investment. They always say don't average down, but do I ever do it? Oh, so averaging down is the only way to make money as a trader. But you have to average down at the right places. Most traders average down stupidly because they don't know what they're doing. They just average down randomly. I don't. An example is if you look today, this little liquidity map here, it's not averaging down, it's cost basis management. There's sometimes you do, there's sometimes you don't. Here is a long setup to DD band. That was today's move. Had we fallen to here and moved up and then fallen to there, there's another leg of a trade that's also viable from here to also there. This is long 1A from the rule, 1B from the rule. There's 2 different trades. I would take this one and take this one and stop out of all of it here. So it's not really averaging down on a loss. It's 2 different possible winning hands. It's like being at blackjack and I got 2 different hands, right? I got a jack under here and a jack under here. They flip me over a 3, womp womp, and here they flip me over an 8. This one has a lower probability of winning than this one. I'm just playing 2 hands at once. This one and that one at the same time. But yeah, averaging down into a loser is what you don't ever do. But this isn't a loser. This is just a like as the market is random, how it behaves, the market can pivot anywhere inside of here. And so I'll play both the hands so I can catch the wave. If it breaks through here, okay, then I'm going to exit out. And then when it gets to here, I'm going to long again. I'm going to take stabs at here, here, and here today, right? Fortunately, I missed this one this morning. So if one were to like trade small, small, and small all day long, this isn't necessarily averaged down into losers. This is just understanding that the bigger market is pushing higher. It's just taking 3 different hands. And as long as the distance it moves, this is only 20 points. If the first trade is upside down 20 points, then make it very small, like super duper small. Like if my normal position was 10 contracts, I might throw like 5 micros right there. Okay. Zoom quit. Oops, Zoom crashed. Well, it's a good enough time to call it a day. I'm not doing more trades anymore. And Zoom just crashed. So maybe it's time to go. No trades, nothing. Market's still kind of bullish. Let's do that Zoom call today, and we'll cover the CD band, and we'll cover some risk interval stuff. Click that link above if you guys want to come to the Zoom call. Like I said, it's $1 a day for 20 days. They're all recorded, posted in the Discord. The amount of information you will learn about the stock market, hands down, will be more you've ever learned in the last 5 years of trying to study the market. We give you everything that you didn't know. Like I said, if you don't come out of there learning at least 10 things that blew your mind, just be like, give me my $20 back. Click the link. The 20 days thing. I want you guys all to check it out. What we're doing with the capital that we're raising is investing into creating probabilistic backtest here on the platform. On the platform itself is we're going to put the stats and probabilities on the platform. That's our next wave. We need to hire some more developers. And as you grow with us, we grow with you. Keep making more stuff for you guys. Today we'll be covering the risk interval, how Nasdaq spanned exactly that distance off of this event, and also be covering a little bit of the DD band. It's a great segue into it today. Both of those things happen. So today's course, risk interval and DD band, the most important thing to all of our techniques is this risk interval. Underlying in the hood, it is a reveal as to the market maker's own risk, because that's what SPAN actually looks at, the risk profile of market makers, to determine the margin requirements. So we figured out those risk profiles underneath it, and we